Hello, everybody, and welcome back to the channel. My name is Andrew. Today, we're going to be touching base on just some economic indicators that's been going on last week. If we've noticed, if we go to, let's say, a month chart, we'll notice in the last Friday we had a good little bounce of about 2%, and an additional today we're up, my count's up about 1.7%. But the market, if you look at the S&P, up just under 1%. The NASDAQ is the clear winner at almost 1.5%. The Dow Jones Industrial Average is kind of idling along, barely moving up and down. And you might be asking, what's been going on? Well, the big thing that has been going on that people haven't really cared too much about is continuing jobless claims has started to fall. We saw back in May it peaked at about 25 million people, and we saw a dramatic drop to about 20 million. And since the last couple of weeks, we've been slowly ticking down. This last time gaining, about 750,000 new jobs, which is a good thing. But at the same time, if we just take this chart and zoom it out for you to see real quick, we're going to see that over the long term, we've never seen this kind of spike ever in history, and we've never seen this many people unemployed so quickly. So we don't really know what's going to happen. It is a good thing, but it's still to think there are still almost 20 million people without a job right now. That's kind of affect the market. Another thing that caused the markets to bounce starting last Friday was pending job home sales. So we can see from this article, pending home sales spiked about 44%. What that means really is they're still down on the year. What it really means is that we saw a huge sell off and homes were just not selling in the market. People were not buying. And since it bottomed out in May at a negative year over year growth of 33%, there was a huge uptick back up. Still negative year over year, but the plus side is it's much less than the previous 2 months. So that's kind of an indicator that people are buying homes, people are going out and spending money. The thing is, too, is that not all these homes will sell. They're just pending a sell. But it is a good sign because mortgage rates are so low that we're going to expect to see more houses sell in the market. This is also due because there's less homes available because people are pulling their homes because they're worried about COVID. And as a result, there's less houses in the market with the same number of buyers. So we're going to have to keep watching this and see kind of where it goes. But it is a good thing showing that things are kind of coming back. I did want to touch base. It's kind of a sensitive subject for a lot of people, but coronavirus. So we can see on a daily chart, we've recently hit record high number of cases per day, and active cases is starting to climb dramatically as well. And one thing to be concerned about when it comes to the stock market is that if more states either reverse their phase system for coming back to normal society or they go back under lockdowns, we're going to see another drop in the market. It's inevitable. It's just going to happen because you're grinding the economy to a halt. So as a result, stock prices have to fall. Just something to keep in mind. It doesn't necessarily mean it's going to happen, but if a lot of states start having to go into these second stage of lockdowns, you will definitely see a downturn in the economy. It's kind of our market right now is currently copying basically 2001, or at least there's an 80% correlation with 2001, which had the same kind of dramatic fall, rapid growth, and then after that it fell another 20% before ending the year only negative about 12%, but it still had a second drop. So we could see something like that. We could not. If the Fed continues to pump out more money, there's a chance that the economy doesn't go anywhere, and it just kind of is solely dependent on the Federal Reserve pumping out more money, more stimulus, which I personally don't think is a good thing. I think if we're dependent on the Fed to move the markets, then we've totally lost the idea of capitalism. But regardless, just something to keep an eye on. Some people have argued that we're in another bubble, and I don't agree with that. And the reason why is because we have to remember that the stock market is a prediction of what people think the next 6 to 12 months is going to be, not what things are going on right now. So, yes, things are bad right now, but people are assuming over the next 6 to 12 months the economy is going to get better and things will open up more. If it doesn't happen, then we can talk that maybe things are overpriced. But currently, there's just a whole lot of uncertainty, and no one really knows. And so it's difficult to make assumptions that we know where the market's going. Because remember, it's impossible to time the market. So you really should just do what I always recommend, which is dollar cost average in. Put $20, $50, whatever you can afford into the markets, buy into a broad index fund, buy and hold the position. Don't sell anything. Don't feed into fear. Have it auto deposit, auto invest, and not have to worry about it. If you want to do more, great. But realistically, most people aren't invested in the stock market. And so for a lot of people, just to get more comfortable, I recommend any of these funds that I have right here. This one here is a growth fund, so it's based on the S&P. I actually have a position inside of this company, or I guess not company, but ETF. It's the same thing as the S&P. They're large cap, they're large cap growth funds. So it's the similar companies, but specifically picked out of the S&P 500. I think it's only 260 companies instead. And if you want to look more into that, it's really easy. Just look up VUG Holdings. So just look up VUG Holdings. You can go to, I like to go to Zacks Financial because they hold all the holdings. They show everything. A lot of websites only show 10 of the holdings. And you just go look. Yeah, so it looks like there's 274 holdings in here. Some of the big ones, just like in S&P 500 accounts, could have Microsoft, Apple, Amazon, Facebook, Google. That's what Alphabet is. It's the parent company to Google. The reason why there's two right here is because they're different type of shares, but they're the same company. Just one has preferred shares and one is regular shares. They have different voting rights when it comes to quarterly reports. Doesn't matter. Point is this is Google. This is Visa. We all know Visa. They're a paying company. MasterCard, Home Depot. They're the home renovation company. Netflix, Comcast. You get the idea. These are big companies. You recognize most of the names. Oh, look, there's a little Tesla in there, about 1%, which is cool. Ultimately, it's a growth fund, so it's meant for long-term growth. It has outperformed the S&P at least in the last 10 years, and so that's why I like it. I have nothing against the S&P 500. I've had money invested in it for a while, but I've done a little more research and kind of found I prefer this holding just because, yeah, it's a little less diverse. It's still 274 holdings, and it's very heavy weighted into technology, so that's something to be aware of. The S&P right now is about 25% of the holdings are in technology versus that fund is closer to about 40%. Just keep in mind it is a little tech heavy. Personally, I think that tech is going to grow over the long term. Technology is bleeding into every bit of our lives, and there's no reason why it should stop now. So anyways, I hope you enjoyed the video. It's really short. Not really sure what else to talk about, so I'll just kind of keep updating you on the economy. Companies that I'm buying into, I average into a couple of index funds every week, but I have been buying more of Discover Financial and more Disney as they're at these discounted prices. I think we're going to see a big move coming up in July. There's just going to be a lot of movement. It's earnings season, and we're going to get these the second quarter earnings that are going to have a lot more impact because of COVID, and they're going to give us a picture of what was going on in April and May and beginning of June with the reopening. And so we're going to kind of see what the economy really was and how these businesses really were performing. And if it's worse than expected, then it's possible that this market drops, or it's possible they gain because it wasn't as bad. So we'll have to wait and see. I hope you guys enjoyed the video today, and have a great day. Cheers.